Hi, I'm Finucane, Chief Investment Officer at Oxbow Advisors. Here's what we're seeing after a month where both stocks and long-term bond yields moved higher. This chart from Investec Research shows investors' lack of fear when it comes to owning stocks. Margin debt is how much investors have borrowed to buy even more stocks. As a percentage of GDP, we are at levels only seen at the height of the dot-com bubble and in 2007 before the Great Financial Crisis. Margin debt is not a leading indicator. It moves in sync with the market, but we think it's telling that the level has reached such an extreme. If margin debt starts to decline, there's a long way for it to drop to reach its long-run average. That means greater downside risk for the stock market too. Street projections still assume 11 to 12% annual growth in earnings for the S&P 500 over each of the next 2 years. One big assumption within that is margin expansion. Forecasters project a record 14% profit margin for the S&P 500 in 2026. A higher profit margin projection must come from the tech sector. That's been the driver of margin expansion for the past 3 decades. It's possible that technology companies can continue this amazing run that they've been on, but this is turning into a bet on a single factor, which is not something we recommend for balanced portfolio investors. We own some tech stocks like Microsoft, Visa, and MasterCard, but we don't want it to be the thing that our entire strategy depends on. If technology is going to continue to be the big winner, it's going to be because they've figured out how to use AI to become more efficient and effective. Tech and services businesses have higher profit margins and higher labor expenses compared to the average company. It makes sense that these industries are using AI the most. They have the profits to invest now to see if there's anything to be gained from AI, and they could be the biggest beneficiaries if AI agents can reduce their labor expense in the long run. We want exposure to top businesses across an array of criteria. High profit margins from MasterCard, McDonald's, and Novartis. Low capex needs from Booking, Colgate, and VeriSign. And another criterion that we want to have in our portfolio is just flat out cheap valuation. Over the past 30 years, buying from the cheapest 20% of the universe using key valuation metrics like free cash flow yield has led to about 5% annual outperformance across all developed markets. We always want a portion of our long-term growth portfolio in cheap valuation stocks, so long as they also meet our criteria for good business quality. Right now, most of these stocks are coming from the energy and healthcare sectors. The current underperformance in healthcare is something we've only witnessed half a dozen times over the past century. Healthcare has underperformed the S&P 500 by about 35%. That has only occurred 5 times in the past 100 years. In each previous case, the sector started to perform in line or better than the overall market in the ensuing years. Another positive indicator for healthcare is that corporate insiders have drastically increased their buying of company shares. When tracking the public disclosure of corporate insider trades, the selling by insiders has little predictive value. But a big jump in insider buying does have a track record of better performance ahead. Corporate insiders in the healthcare sector have increased their insider buying compared to selling, and in the past 15 years, that has led to an average return in the mid-teens over the next year. In the high-income strategy, 2 sectors where we increased our exposure in May were in energy and precious metals. Gold started the year strong and has held its gains over the past month and a half despite changes in direction from other asset classes. Our additions were to companies with exposure to gold and silver that we think will report excellent earnings and cash flow in the quarters to come. On a cautionary note, the yields on long-term government bonds continue to trend higher around the world. The 30-year U.S. Treasury yield is now about as high as it was in 2007. We see multiple headwinds working against a reversal of this multi-year uptrend in yield. We have been keeping our fixed income exposure in short-term paper, typically maturing in 2 years or less. Besides staying away from long-term bonds, it's important to know which stock sectors also are hurt from rising rates. The home building stocks remain in a bear market. Mortgage rates staying high are taking their toll on the housing environment. And REITs are another area where we are keeping our exposure smaller than usual since they tend to underperform in a rising rate regime. We hope that gives you a sense of what we're following in the markets right now. If you have any questions or would like to learn more about Oxbow, please contact us. We like to provide the information we think is most valuable to investors. If you'd like to see more of our insights, please subscribe to our YouTube channel.